Okay, now let us begin that what the central bank will do with the CRR, that is your cash reserve ratio, and SLR, that is your statutory liquidity ratio, in case of inflation and recession. I've told you that CRR is that part of deposits of commercial banks that they have to keep with the central bank. So in case of inflation, the objective of the central bank is to reduce the availability of money with the commercial banks and to reduce the availability of money with the public. Okay, eventually. So what they do, they increase the CRR. They will ask the commercial banks that from today onwards you have to keep more cash reserve ratio, you have to keep more percentage of your deposits with us. Okay, and what is the reason behind this? Why they are doing this? Why they are asking commercial banks to keep more part of their deposits with the central bank, so that the commercial banks are left with less deposits, and when the commercial banks are left with less deposits, they'll be able to create less credit. We all know that. So simple to understand. An opposite thing they will do in case of recession. Okay, they will reduce the cash reserve ratio. Reducing the cash reserve ratio means asking the commercial banks to keep less part of their deposits with the central bank, so that the commercial banks have more availability of credit and money, so that they are able to lend more and more money to the public at the cheaper rates, and the recessionary pressure can be improved in the economy. Same they will do with the statutory liquidity ratio. Only the concepts are different rather, but your adjustments are same. In case of inflation, the SLR will be increased, so that the more portion of their deposits the commercial banks they keep with themselves in cash, in the form of gold, bullion, government securities. Okay, so that they have less money to lend to the public. And in case of recession, they will reduce the central bank reduces the SLR, so that the commercial banks have more availability of credit. They are able to lend more money to the public at cheaper rates. So you should be very clear with each quantitative measure, their meaning, and how they are adjusted in case of inflation and recession. See, if you're clear with the meaning of each quantitative measure, if you're clear with the meaning what is bank rate, if you're clear with the meaning of repo rate, reverse repo rate, open market operations, and your cash reserve ratio and statutory liquidity ratio, then it is very easy for you to see the adjustment or to conclude the adjustment in case of recession and inflation. Because the major objective of the central bank in case of inflation will be to reduce the credit availability, money availability with the commercial banks and the public. That means to absorb more and more money from the commercial banks and the public. Write it somewhere that in case of inflation, the objective of the central bank is to reduce the availability of credit, or the reduce the availability of money with the central bank, with the commercial banks and with the public, and to absorb more and more money and credit. Whereas in case of a recession, the objective of the central bank is to inject more money supply in the economy. Okay, their objective is to increase the availability of credit and money with the commercial banks, so that they can lend more money to the public at cheaper rates. All right, so this is how, with the help of quantitative measures, with the help of this part of monetary policy, the things are controlled. The availability and cost of the money is controlled. Okay, in India, bi-monthly, these things are रिव्यूड लाइक हर 2 महीने के बाद इंडिया में एक मॉनेटरी पॉलिसी कमेटी है, वो मीटिंग होती है उनकी, और वो देखते हैं कुछ इकोनॉमिक इंडिकेटर्स एंड दे सी कि उनको रेपो रेट, रिवर्स रेपो रेट, सीआरआर, एसएलआर घटाना चाहिए या बढ़ाना चाहिए. अकॉर्डिंगली दे डिसाइड. ऑलराइट, so you should be very clear with these things, because these things are very applicable in nature, these things are very practical in nature.